For more on the economy and the Fed's latest rate cut and messaging, let's bring in Richard Clarida, former Fed Vice Chairman and now Global Economic Advisor at PIMCO. So we were talking, it was 3 minutes ago. I think I can remember. Do you remember what we were talking about? Let's just recount what I asked you when you sat down. First thing I said was, is it possible that the Fed hikes next year? And you said probably not. Yeah. And then I said, do you think the risks are asymmetric? In other words, I'm asking whether both mandates are equally important right now. And I think you started to tell me that no, that the inflation, the dollar stability side of things is more important to what the Fed should be doing right now. And then I said, well, then why are we cutting?
Okay, well, I do think the risks to inflation are to the upside, and I think the committee and the chair acknowledged that yesterday. I think the case for cuts going into September was the data was cooperating and they felt the policy was restrictive. I think the case for a cut yesterday was a close call. Indeed, we had President Hammack dissenting, and we had the unusual situation, Joe, where three other officials, presumably presidents, also indicated that they didn't support the cut through their dots. So I think it was a close call. I do welcome the fact that the committee, this first phase of recalibration appears to be over, and they're now really talking, and I believe them, that they're going to be very data dependent about the timing and extent of future cuts, and I applaud that.
It's just, Richard, the whole nebulous idea of restrictive versus neutral. Just reading an article today, it basically says that the way the Fed decides what is neutral and what is restrictive is based on the economy and conditions when they look around and what they see. Yeah. And that's why I would have thought I would have come to a different conclusion given the stock market, the GDP number we just posted, Bitcoin, we've talked about the banana on the wall, all the things that we see didn't appear that we were in restrictive territory and didn't seem like an environment where you would have cut 100 basis points.
Well, my comment on that is very consistent with what you said. It's a complex economy, financial markets. Financial conditions broadly defined, including the Fed's own index, are easier than they were before the first hike. They've eased a lot, higher stock prices and tight credit spreads and all the rest. The Fed also, of course, focuses on the rate they control, which is the interest rate. And so they judge, and I use that word precisely, they judge that policy is restrictive. But they also acknowledge on the committee there's a range of views about that. And so that's why I think it is appropriate as we look into 25 for them to move away from a model-based, we judge we're restrictive, to more of a data-based, are we getting that progress on inflation? Quite frankly, a year ago, December of 2023, the year-over-year PCE inflation rate was 2.9, and that was good news. It was below 3 for the first time in 3 years. It's going to come in this year at either 2.8 or 2.9. So by that metric, actually very little progress on their preferred measure. So they're forecasting additional progress next year, but right now that's a forecast. And so I think data dependence here is the way to go.
I'm old enough to remember a bunch of times when the Fed had to take back things they had done. Yeah. And I just hope that this time, that one of these times in the middle of doing something like this, we're pointing out that this may not, we may not know that we're in the midst of a policy mistake. We may be in the midst, like when we were at zero for too long. Did we really talk about, did we know we were in the middle of a policy mistake? Could we know right now that we shouldn't be easing?
It would be difficult given, I think, that the labor market data, and Steve raised this point, I think if you are looking for evidence that confirms the wisdom of some of the cuts, is the labor market is slowing, particularly private employment. The Fed does have employment as part of the mandate. But because of those long and variable lags, Joe, typically you don't always know in the midst of a policy mistake until sometime into it. So I couldn't rule that out.
I mean, we could be cutting like crazy in a year because the labor market weakened so much.
Yeah. I just want to try this math on you, Joe, and some clarity from Richard Clarida here.
Clarity from
Clarida, because nobody else can do it like he does. Joe, if you had a 7% inflation rate and a 5.3 funds rate, and that 7% comes down to 2.5 to 3, you need something less than the 5.3. Right?
No, not necessarily. I'd like to keep it there. If I'm not I'd like to save my powder in case, because the economy hasn't.
Keep slamming down.
No,
on the
it's
economy.
not. Where do you see evidence of slamming?
Well, that's a good point, because the thing I want to ask former Vice Chair.
Former Vice Chair, yes.
You're still a Vice Chair to me.
Okay.
Isn't some of the relaxation in the financial conditions right now a direct result of 1 year ago or so when the Fed pivoted?
Yeah.
So that's
sure.
what you have in the economy right now. If the Fed had not pivoted, you would not have these financial conditions.
Sure. Yeah.
So therefore, it was sort of a result of that, or maybe the right thing to do.
The other thing I will point out, though, is the disinflation from 6 down to 2.5 is remarkable. The fact that we avoided a recession is welcome and unusual. I'll also say this, and the chair himself towards the end emphasized it yesterday. The U.S. economy is quite remarkable right now. We have the highest productivity growth in the world. We have an innovative economy. We're energy independent. Household balance sheets are in great shape. So we keep focusing on things that potentially can go wrong. And I think even the Fed is disappointed that progress on inflation appears to have stalled. But the fundamentals are quite good. So part of the buoyancy and risk appetite is, where would you rather invest right now, the U.S. or almost any other country in the world? So I think that's part of it as well.